everybody, it's your boy Sean McLaughlin at Options Sean on the old Twitter X. Today is Tuesday, March 10, 2026. This is the What Are My Options show. Sorry for a little late start here, programming congestion on the stream. But here we are. And for those who don't know, or if you're your first time here, this is it's a free for all. It's an open office hours. If you have questions about anything related to options, whether it's about strategy selection, how to implement a strategy, how to manage risk within a strategy, let's talk about it. Let's hash it out. If you want help on some existing options positions you have on, you want some insight on what to do, what to roll, any repairs you need to do, we could do that too. Let me just first off apologize for my sunburn. Look at my sunburn. You see this? Today is March 10th. 2 days ago, March 8th, I got my first sunburn of the year here in Colorado. I have no idea how that even happened. I was outside, I was reading a book, I was having some coffee with a friend, sitting in the sun, and boom, I got all red. So looks like my face is glowing there in the screen. So I apologize if that's distracting. I see a lot of people in the chat already. SM Traz, Jackson, P Guns, Randy, First Last. Shout out to all of you guys. I saw Dan's in there. Pika says, Sean, the Sabres and the Tampa Bay Lightning seem to hate each other. That's news to me. I saw that game the other night. Holy cow. But hey, two teams battling for first place. The Sabres have not been in the playoffs since, I don't know, since Nixon was in office, it feels like. So things are hot. Things are hot. All right. So I know that there are some questions in there. I will get to your questions, and if you have questions, guys, put them into the chat, please, and we will do our best to address them. But before we get that started, I just want to kind of maybe kick it off by, just kind of talking about the regime change, or is it a change? Are we already past it already? Let's bring up my chart here, Gene. I got the VIX chart up on my screen. And man, we had VIX spike up into the 30s yesterday. First time we've seen the 30s in quite a while, but it got quickly faded. Quickly faded. We're back now in the low 20s. But it got me thinking, guys, when volatility is spiking, and I think we've talked about this before on What Are My Options, but when volatility is spiking, are you seeing the Oh, you're seeing something. You're seeing my simulator. Let's get that off. You guys don't want to see that. Let me change my screen, guys. Sorry. This is what happens when we start late. Apologize. We'll get this fixed. Let me get the right screen going for you guys. You guys want this screen. Gene, does that look better for you? Sorry, folks. Technical difficulties is what happened. Is it still showing? Is it very stretched? We need to resize it a little bit. All right, hold on. Yes, we got new monitors here last week, and it's kind of changed everything. It's kind of messed everything up. Uh, how does that look? Is that better? Is that- All right. Well, Gene is fixing the screens, guys. Sorry about that. Let's just talk about the VIX. And where I was going with this, guys, is that when volatility pops like it did yesterday, it's very if you're an options trader, the first thing on your mind often, and if not, it should be, is that, ooh, this is a good time to sell premium. However, you don't want to sell premium into the spike. Okay, while VIX is spiking, you don't want to sell it, because if you look at my screen, if you guys can see my screen, you could have a spike like we had back in April where VIX went all the way to 60, right? So what's that, Gene? Okay, great. So if you were selling this spike in VIX here on April 3rd when it got up to 28, thinking you're feeling pretty good about yourself, well, holy moly, it doubled or almost tripled from there. So it's very tricky to sell options premium into the spike. What you'd rather do, what's a better option, is to sell premium on the way back down. So yesterday, as VIX was rolling over hard, that's the time back when it got as high as 35, back when it came back below 30 on the way back down below 30. That's when I start thinking, okay, Now's the time to sell some premium. And I did sell some premium yesterday, and that is the time to do it. Now, look, VIX could go spike again from here. Absolutely. We cannot predict the future. We don't know what's coming. Okay. We don't know, but you want to have the odds on your favor, on your side. You want to be going with the trend. I'm a trend follower. Now, I'm not a trend follower in VIX, but I don't want to, get myself stuck in the eye from volatility just going berserk. So in a tape like this with volatility in the mid 20s, this is a great time to not necessarily be swinging for the fences, but if you're an options trader, call credit spreads are great here. Put credit spreads are great here. Iron condors, if you find stocks or ETFs that are stuck in a pretty good range, if there's volatility in those options, iron condors can be great. I sold an iron condor in Apple last week as well as in Nvidia last week. So far, they're working pretty well. Um, that's the types of trades you want to look for in this environment. Sure, you could buy calls if you're bullish, or buy puts if you're bearish, but you're probably going to be paying up a little bit for that premium. So when the markets change, you have to have strategies that change with it. Okay, you can't be a one trick pony. You can't just do one thing and one thing only. Not that there's anything wrong with that. People who have one trick and beat the hell out of it can do really well. But for most of us, we need to have, especially if you're an options trader, you need to have a variety of tools to get you through regime changes in the market. Now, am I saying the bull market's over? No, I'm not saying that. Let's bring up like an S&P chart here, SPY. I'm not saying the bull market's over. I'm liking the way we've bounced the last 2 days, and we're still above a rising 200-day moving average. So it's still a bull market until proven otherwise. But as you can see, at least on the index level, we've been going mostly sideways for the last 3 months. Of course, under the hood, there have been a lot of high beta names having big moves, which I've participated in various ways. But guys, just remember, as an options trader, options give us options. It gives us the ability to be flexible. Okay, it gives us the ability to dig into our tool belt and pull out different trades and different strategies that have better odds of success when the market isn't what you're used to. Okay. All right. Now that I got that ramble off my chest, let's get into the chat here. SM Traz, you're catching in from or tuning in from vacation. I love it. All right. How about AVAV? I bought the mega dip last week with January 2027 calls. So far, so good. Let me pull up that chart. Uh, yeah, I mean that if you're a dip buyer, that's certainly a dip. Good luck to you. It's not a stock I would buy here. If you bought the January 2027 calls, you got what, 9 months of expiration. You paid some high premium in that. Not that it can't work. Not a trade for me, but good luck. Good luck to you, my friend. I hope that works out. Uh, Jackson says Nvidia looks like it might start moving again. How do you feel about a June 18 220 call for 550? Well, as I mentioned just a moment ago, I have an iron condor on in Nvidia right now. I'm betting on it going sideways a little bit. See this range here? 195 at the upper end, 170 on the lower end until proven otherwise. Nvidia is stuck in a range. And so I'm betting on some sideways action, some continued sideways action. So currently I'm in an April iron condor in Nvidia. An iron condor is a multi-leg spread where you're short and out of the money call, you're short and out of the money put, and then you purchase the long call and long put further out to protect yourself, to define your risk. And you're just betting that the stock's going to go sideways, and you're going to be able to buy that spread back for less than you collected on trade day. So I'm neutral on it, but you're asking if you're asking about June 220. I mean, yeah, if you're bullish here, I mean, for me, I would just if for me to get bullish on Nvidia, I'd want to see it break above 195 before I dip my toes in there. And I don't know what that. Let's pull up the June chain on that. You said you're in the June 220s, June 220s. So June 220s are right here. They got 25 delta. So yeah, I mean, look, buying the 25 delta strike, that's going to give you the right mix of leverage if you get it right, and affordability if you get it wrong. But I mean, volatility is coming back down. It was up a little bit. I mean, into this spike here a couple days ago. That's when I bought my iron condor or sold my iron condor. I sold into this little spike right here. Um, but look, I don't hate the way you executed it. Like you and I can disagree on the thesis, right? I think we're going sideways. You think we're going up. That's fine. That's what makes a market. I have no problem with the way you expressed your trade, buying those June calls with a 25 delta. If you get it right, you're going to kill it, and that's what we're here for, right? So that's my take on that, Jackson. What else you said? You also talked about FPS. Your long term with common. I want to place a bullish trade with options. Stay away from a calendar call and do a vertical spread. Straight calls are a bit expensive. Let's see. FPS. That is Forgent Power. I'm not familiar with this one. Is that the right? Am I doing the right ticker? FPS. Is this a new issue? An IPO? It looks like it might be. Let me just check something here on another screen. I'm just trying to get some more information on this stock because I'm not familiar with it. No, looks like it's a new IPO. Um, Implied volatility, I mean, we have very limited data set to work with, right? We have from February 11th basically until today, so 1 month of IV to look at. Yeah, we're at the higher end of what it's been for the last month, but such a limited data set. Did you say you're long some comments? So you're long stock. That's good. That's good. Let's see what the options look like. Are they liquid? They're not very liquid. That's the other issue. I mean, there's some liquidity here in March, but you only have 10 days of expiration on these. But like, look at these at the money. April's bid 185, offered 340. That's a pretty wide bid-ask spread. So it's going to be tough doing this with options. If you're involved in the stock, which sounds like you are, maybe just work it with the stock for now. Especially if you're considering doing a spread, the fact that there's not that much liquidity just makes it all the more complicated. I guess there seems to be a little bit more liquidity here in May going further out. I wonder if these April options just got listed recently. I don't know. I like the setup. I like the setup. I think just if you're already long stock, just stay with the stock. And if you're worried about, if you're trying to define your risk, maybe play with some puts just to define your risk with your stock, right? You could buy some March 30 puts here for about $1, or maybe 70 or maybe like 90 cents just to define your risk. That'll protect you for 10 days. If you want to go a little further out, you can go into April and protect yourself for about $2. Oops, sorry. But yeah, I think you just stick with the stock on this one for now. All right, P Guns. When you are long puts, for instance, I'm long hog April $18 puts. Do you take half off, or is it a small responsible position? Do you aim for a target of the stock price? That's a good question. Puts are a little bit of a different animal than calls in my experience because bearish moves tend to be a hell of a lot more choppy than bullish moves. A stock that's breaking out in an uptrend can oftentimes, I don't want to say be smooth, but it can have a pretty defined, well-defined trend that could last for weeks and months and quarters if you're lucky. Down moves that you're trying to participate as a holder of long puts, down moves tend to be a lot more tricky. You tend to have a lot of V bottoms. You tend to have a lot of false rallies that are just blistering, shake everybody out, and then the stock rolls over again. It's very tricky. So when I'm long puts, I tend to want to be a little bit quicker to take my profits or have a profit target or trade it with a spread. But either way, I want to be a little bit quicker about taking profits. And so there's a variety of ways I do it. And there's no one way I do it every single time. Who was that asked that? P Guns. I don't do it the same way every time, but I will often, if I'm buying just straight puts, what I will often do is I will have a price target in mind where I will sell half of my position or a portion of my position. All right. Now, where I sell that could be one of two ways. It could be a price level on the chart. Like if I'm long hog right now and it breaks to say down to $16, maybe when it gets to 16, I take some of my puts off. That's one way to do it. The other way is to sell half of your puts if you've doubled your money, just so you can take all of your risk out of the trade. That's another way of doing it. I don't think one way is better than the other. I just think you just need to make up your mind before you get into the trade what you're going to do and then follow your plan and execute. All right. But I agree with you. With puts, it's a little trickier. You want to be a little quicker to take profits because look at the move in hog already. Just like a week ago, it was straight down for about 7 days and then whoo, ripped up in your face. That's pretty common in a stock that's in a bearish regime, like Harley Davidson. So keep that in mind. But yeah, you're on the right. You're on the right track there. Have a target. Have a plan for taking some profits. This is not something you just like try to ride all the way like you do with calls, right? Like if I'm in a long call position and stock's breaking out and it's making all-time highs, I don't have a price target. I want that thing to keep going. There's nothing but blue skies ahead. There's no reason for it to slow down. There's no upside resistance. Not the same with bearish trades. Okay, moving on. Randy. Hello, Sean. Hope you and your family are doing well. Your thoughts about Amgen? Let's pull up Amgen. I was in this one and I got shaken out. I am bullish on this stock. I'm not in it yet, but as you can see, I got a little level up there around 388 that if it gets back up there, I would get involved in the long side. It's been a tricky name. I've actually played this a few times over the last several months and gotten mostly stopped out. I got long here back in November and got caught in this little pullback there, so that sucked. And then I got long up in here a couple weeks ago, and I got stopped out late last week. This has been a tricky one for me, but I'm bullish on it. I mean, look at that setup. If you have a longer time frame than I do, this is a great setup. I mean, for me, I wouldn't buy it until it got back above 388. But I like it. Volatility is relatively tame and coming down, so you could play with straight calls if you wanted. Although because it's a $380 stock, it's the absolute dollars of those calls will be a little bit more expensive than you might like. But no, I like it. I'm bullish. Let's see. What else we got? Secondly, Randy wants to know about Tesla. So Tesla, I just had a bearish position that I got stopped out in. I was long a put spread, got stopped out today. I closed it today. So my thoughts on Tesla are it's kind of stuck in a range. I think the risk in Tesla is to the downside, to be honest with you. I think if this thing breaks below 386, below it, the floor could fall out down to 340, 320. So I'm not looking at Tesla for any long trades here. Look, if you're a buy the dip kind of person, I mean, it is sitting at some significant support here, right? We had support that was formed in November. This area was also loosely upside resistance back in the summertime. We got a 200-day moving average rising to meet the price action right now. So look, if you're a dip buyer, if that's something that you like to do, something that you're more comfortable doing, this might be the setup you're looking for. Volatility is very low in Tesla. So if you want to play this one here, you could trade this with straight calls or a call vertical spread just to keep your costs manageable. But in volatility terms, it's cheap. So if you're a dip buyer, I think this is a good setup. I am not a dip buyer. That's not my thing. But to each their own, right? Okay. SM Traz has options question. You always talk about limiting positions to 1 to 2% of your portfolio. Do you think going above this for leaps 1 to 2 years out is okay since they move less than short dated contracts? Well, you bring up an interesting question, Traz, and leaps are kind of like a blended position between a straight out options position and a long stock position, right? It's not a long stock position because you have defined risk, but you're going to pay enough money that you might as well treat it like a stock position, even though it'll require, I don't know, depending on what strike you get, it might require, only 20% of the margin that a long stock position would be. I think it's a slippery slope, Traz. And look, if you're comfortable doing it and you are very good at managing risk and you have very clearly defined exits, then if you want to take a larger position with a leap, then go for it. Okay. Just know what you're doing. And remember, it's a slippery slope. If you cheat here, you might cheat somewhere else. And then that's where the trouble happens. But like if I'm trading stock, I don't have a whole lot of stock positions these days, but when I do trade stock positions, I will often limit the size of that position to about 10% of the value of my account, right? So for example, if I have a $100,000 account, I won't risk more than $10,000 in a stock position, meaning that's how much buying power, or that's how much the stock costs, 10,000. So if the stock went to zero, I would lose no more than 10,000 bucks, which would be 10,000 or 10% of my account. That would be a bad hit. I wouldn't like that hit, but I can survive that. I can come back from that. So, um, somewhere in between there, 5 to 10, I mean, no more than, I don't know, I'd say no more than 5%. Traz, would I risk in a leap? Again, I would treat it like a stock position. I would have very defined exits, and I would stay on top of it. I don't like staying on top of it, so that's why I don't like doing that kind of stuff. So, um, Traz, just tread carefully. All right, you could do it. Just tread carefully. Let's see here. What else we got here in the chat? We already talked about the Sabres and Lightning. Yep. I see you, Dan. Hey, Dan. SM Traz asking about my Premium X service. Does it have trades? That's exactly what it is. That's all it is. My short-term options trading that I do, this is outside of all-star options. My short-term options trading is really just for junkies. I'm putting out options flow all day long. Some days we may do as many as 10 or 15 new trades, new entries, and then often at the end of the week we'll trim out all the losers. I'm very aggressive about trimming out my losers. All I do is hold winners all the way to expiration. But it's light on content, heavy on ideas. It's for idea flow. If you're looking for idea flow, all right, it's a great service. It's ridiculously affordable. It's 49 bucks a month, and you get to see all the trades that I'm putting on in my short-term options account. And it's only for people who are looking for a lot of ideas. If you're a swing trader, you're only putting on a couple trades a week and you want to sit in them for months at a time, it's not for you, right? It's for people who are very active, who want simple options trades. They're simple long calls and puts and long calls and vertical spreads, just very simple. And we hold our winners all the way to expiration and we exit the losers uh, aggressively. And that's it. It's a very low win rate. We win like 20% of the time, but the wins, some of them are enormous and they more than make up for all the losses. And that's the whole game there. So thanks for asking, Traz. I hope that answers your question. Hit me up on Twitter if you want more questions on that. Happy to talk to you. Anything else here? Sure. Let's see what else. GameStop. GameStop. Are we talking these old meme stocks? Are these things coming back? Was I GME? Man, those things still alive. GameStop's trading at 24. Yeah. Look, I mean, if you're bullish on it, volatility is relatively low. Take a shot. Take a shot. I mean, just treat it like any other position. If you look in the April options here, the 25 Delta strike, you could buy them for about 65 cents. That's a $29 strike. If you're bullish on GameStop and you think it's going to rip, why not? Right? Volatility is low. Go for it. AMC, is that thing still around? I thought that was like a penny stock. Yeah, it's a dollar. AMC, get out of here. You don't need to trade options on a $1 stock. Just buy the stock. Your risk is a dollar. Uh, okay, Richard's asking, Sean, would a straddle, strangle, or butterfly be a better use of funds compared to an iron condor? Well, let's put straddle out of the mix right away. Straddle would not be, because a straddle would require a lot more buying power, because a straddle is a naked call and a naked put. Okay. So maybe let's bring up an example here. I'll bring it up on my screen. Let's go to my analyze tab. Let's go to like SPY, just because SPY is very liquid. Let's say we're looking at April options. Okay. Now if I were doing a simple, a typical strangle, okay, let's widen up my strikes here. Ugh, why does that do that? 50. Okay. So if I were to sell like the 25 Delta put and the 25 Delta call, oh, I got to go even wider than that. Wow. Um, let's see. We'd sell these. We'll sell the 655 put strangle here. And we'll go 25 delta call, which is about the, we'll call it the 705, just to use nice big round numbers here. So we get 1239 credit roughly for that trade. Here's the risk profile, what that looks like. But you'll notice, if I zoom in a little bit, we've got unlimited risk, undefined risk, right? Because they're naked calls and they're naked puts. And so if I were to do that trade, hold on, this buying power is not correct. Because an IRA account. But I believe that this margin to hold this trade, depending on who you trade with, it's going to be in the neighborhood of 10 grand. Let me bring up another. I'm just going to look on my other platform over here and put up the same trade just to see. I'd probably get a better sense of what the margin requirement would be over here. 705. Boom. Okay, yeah. So if I were to put this strangle on, the margin requirement on this trade would be just under $11,000. Now, if you have a large account, maybe that's no big deal. That's fine. Okay. But a strangle takes a lot of buying power. So you have to have a lot of buying power to be able to do this trade. And also, a strangle or a straddle has undefined risk. It looks like I'm looking back at your note now. It looks like you said, oh, you did say straddle and strangle. So a straddle, this is a strangle we're looking at right now. That's the short out of the money put and out of the money call. A straddle is basically the same thing, except you're short the same strikes. So instead, you'd be short right in the middle here. You'd short the 680 put and you'd short the 680 call, right? You get a higher premium, but you also have a little bit more at risk. Okay. You were asking better use of funds. Well, if you're doing naked options, you're not getting the most effective use of buying power. If you want to have effective use of buying power, you want to have defined risk, because then the buying power that's required is only whatever your max loss is. So an iron condor or a butterfly have defined risk because you have short options paired against long options that define your risk. An iron condor, for example, let's put together an iron condor trade here. We'll do similarly. We'll do similar strikes. We'll do the 655. Let's go here, 655, and we'll buy the 645 puts. And then on the upside, we'll do the 705 calls and 715 calls. Boy, I got to do a lot of scrolling here with so many strikes. So now here's what an iron condor looks like. Notice the difference. Let me bring the strangle back up. Here's a strangle. Okay, we're short the same strikes, but there's undefined risk. You can see these things just keep sloping down and away. There's no stop to those slopes because it's undefined risk. But if I short the same strikes, but this time do an iron condor, you'll notice that our risk is defined. These blue lines show me the most I could lose. In this case, 577 on either side. So if SPY rips higher or if SPY rips lower, the most I could lose is about 578. Okay. So, and also the buying power effect is only $1,000. You can see it right here. Actually, it's $1,000 less what I collect. So if I collect about 425 for this right now, the effective hit on my buying power is only going to be about $575 for that one lot versus 10,000 for a strangle. Okay, that's 20 times more margin than what you require for an iron condor. So if you're looking for buying power efficiency, when you're looking to collect premium, I would do defined risk spreads, either iron condors or butterflies, or vertical spreads, right, where you're short a call, long a call, or short a put, long a put. Defined risk is the elixir to keep your margin in check. All right. Let's see. Anything else? Sean, have you ever come across TA for options charts? Technical analysis for options charts? No, you can't do technical analysis on options charts because most options just aren't liquid enough. They don't trade enough for you to do technical analysis on them. I think that would just be more trouble than it's worth. Godspeed to you if you're going to do it. Randy's loving the VIAV after the 10% drawdown. Yeah, we shorted a put spread in VIAV and all-star options. We shorted it right here during this big red candle day. And I think we're probably got to be pretty close to our profit target on that thing. Let me see. I'm going to pull it up. It's on my other trading platform here. I'm trying to, we're short the 27 puts and long the 22 puts in April. We sold it for about what, a buck 30, I think, the other day. It's trading at 75 cents right now. I got a limit order to buy it at 65, so I got 10 more cents to go. I think we're going to get there. Yeah. Texas Saint is asking if I would consider re-entering Vail or Well at this time. So in All-Star Options, those are two trades we just exited recently. Let's take them one at a time. So Vail, we exited. Vail, I'm good with Vail. We had an incredible ride in, no, sorry, it's Valet. It's not Vail, it's Valet. We had an incredible ride in Valet. We got in back here back in September, bought, let me bring it up on my other chart here. Just want to give you some real detail. Back in September, we bought the December 12 calls. So right in here, uh, yeah, right in here, we bought the December 12 calls for 75 cents. We sold half of our position as we said we would when we got up to here around 16. Took some money off the table. That was all part of the plan. And then we got stopped out on the rest right here during this little chop fest. But you know what? My average exit on that was $4. Bought them for 75 cents, got out for an average price of $4. Killed it. Great trade. I'm good with Vale. I don't, would I get back in? Yeah, sure. If the stock gets back up above 1750, but I would treat it as a brand new trade. Brand new trade with fresh option strikes, fresh expiration months. Might not even be a call trade. Maybe it'll be a calendar spread or something like that. I would get involved, sure, but as far as I'm concerned, the old trade that we were in, that big ride that we rode, is over, and I'm moving on. Now, as far as Well goes, well, we may have gotten caught in a whipsaw in Well. We were long calls here. Got in right here in early February. We may have gotten whipped out right here. As you can see, I got an alert there set around 212. If we get back above 212, I will consider getting back in. Yes. And nothing wrong with getting back in. In fact, I was talking about in my premium X subscription service the other day. I was looking at the options that expired in February, and I was looking at all the biggest winners, and 10 of my top 10 winners, out of my top 10 winners, excuse me, two of those trades were trades that I was in previously, got stopped out, and got back in. So had I not gotten back in after getting stopped out, I would have missed out on two of my biggest wins of the month. So nothing wrong with getting back in. All right. Let the stock prove it to you. You want proof. That's what you need. All right. Okay. What else we got here? I'm starting to run out of time here, I think. Calls or puts on IWM for CPI tomorrow. I got nothing for CPI, my friend. Only price pays for me. I don't follow government reports. They're all bullshit anyway. They all get revised a million times after they announce them, so I don't know why people trade those things. The Navy did get a tanker straight with no problems. Okay, all right. I don't know options, but I buy the common shares. Okay. Well, Anthony, thanks for giving us the news on CNBC. Again, another thing I don't pay attention to. I only follow price. All right. Sorry for the late start today, guys. But thanks for tuning in. A lot of great questions today. We'll be back next week. Yeah. We'll be back next week. In 2 weeks from today, we're not going to have a show because I will be traveling. But we will have a show next week. So we'll see you again next Tuesday, same time. Hopefully we start on time. 1 p.m. Eastern next Tuesday. Also, this Thursday coming up, we'll do the All-Star Options Jam session at 3 p.m. Eastern, where we review action in the All-Star Options portfolio. And there's been a lot of action this week, so we'll have a lot to talk about, as well as some lessons from that as well. All right, everybody, be well. Have a great rest of your trading day, and I will see you on Thursday. Take care.